January, the first month of the year, is known for its volatility due to the release of quarterly earnings and, of course, the highly anticipated Indian budget. Now, we can see this trend this year too. In this DITM, let's take a trip down memory lane to see how the markets have reacted on budget days and post-budget in the last 17 years. Now, India is set to release its budget on Thursday. However, this time around, it won't be a full-fledged budget but an interim budget, as it will be presented before the elections. Now, typically, the interim budget won't include big policy announcements, and even the Finance Minister Nirmala Sitharaman said there won't be any big shake-ups or surprises. However, the detailed budget will take place post the election and the formation of a new government. Nevertheless, let's analyze how the markets have moved on budget days and a month later. Analyzing the market trend on budget days for the last 17 years, negative trends have occurred 9 times with the highest fall of 5.8% in 2009. Now, in the remaining 8 budget sessions, the markets trended positively. Now, while we see extreme volatility on budget days, the market has shown improvement in the month following the budget with an average return of 0.41%. Now, so we see in the past the union budget has evoked diverse market reactions ranging from highly positive to negative. Now, it is difficult to predict the exact reaction of the stock market. However, a budget that is perceived to be pro-growth and business-friendly may lead to a positive reaction from the market. Also, effective management of the government finances, particularly reducing the fiscal deficit, is also very important. Now, let's break down the examples of how the markets have seen significant positive movements during budget announcements. Firstly, let's go back to 1991 when Manmohan Singh presented a budget that marked the start of economic reforms and the end of the license Raj. Now, this budget was a game changer, propelling markets to rise about 5% on the budget day and 27% a month later. Now, moving on to 1997, P. Chidambaram, the then finance minister, made a noteworthy announcement by implementing a substantial tax cut. He reduced the maximum marginal income tax for individuals from 40% to 30% and for domestic companies to 35%. Now, this move had a positive impact on the stock market. In more recent times, in the 2021 budget, the government's focus on the growth-oriented and balanced approach also garnered approval. Now, key proposals such as the privatization of 2 public sector banks, emphasis on infrastructure development, and an increase in the FDI limit in the insurance industry helped the market increase more than 5% on the budget day. Now, we see how budgets react to pro-growth, consumption-driven initiatives. Having said that, the union budget is an important event, but it's just one piece of the stock market puzzle. Now, looking ahead, in the absence of major policy announcements in the interim budget, market movements will likely depend on macroeconomic indicators such as fiscal deficit, GDP growth, and CPI inflation. It will also depend on US Fed's interest rate decision and the Q3 earnings season in the following week. Having said that, this is me, Merlin Sana, signing off. Take care and stay invested.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.
Equity investments are subject to market risk. Read all investment-related documents carefully. Visit www.researchandranking.com.